This month on the Market Update, we'll start with the stock market crash, the rise in bond yields, and what that means for real estate.
Home sales are down, prices are up, and rates are volatile. What do you do when the market sends mixed signals? Stay tuned, you'll find out today.
And finally, we'll talk about mortgage rates. Where are they going, and how's Fed policy going to evolve?
All that and more on today's Market Update.
Welcome to this month's Market Update. I'm here with our special guest host, Joy Powell. How are you, Joy?
I'm good. How are you?
Great. So our first topic this month, the stock market crash, bond prices changing. What does it mean for real estate?
Hot topic right now.
Yeah, exactly. So let's jump into the numbers. So it started April 2nd. After the markets had already closed, we get the tariff announcements, right? April 3rd, markets dropped 5%. April 4th, 6%. Overall, from peak to trough, we ended up down about 18%, which, 20% is the bear market. So we were like right at the edge of it. We didn't quite get there. And then as we're sitting today, this morning we were 12.5% below peak. So we've come up a little bit from the lows. We don't really know where it's going forward.
So tell me, if I'm an agent talking to a consumer and a consumer that, isn't listening to their news on TikTok, what does that actually mean for me today?
I mean, I think it's different for everyone, but I think a lot of people have seen their net wealth decrease a little bit, right? 18% off of the, S&P 500, that's impacting a lot of people's savings, right?
Yeah.
I know, you were telling me that we've seen some stories of, buyers having basically their down payments reduced as a result of this.
Just a couple months ago, I had a buyer that wasn't that serious and then decided a couple weeks ago to be more serious and saw that their savings in the stock market for their down payment dropped $20,000, which no matter what price point you're looking at, $20,000 in the down payment is a significant difference.
Yeah. So I think that's, the most direct impact, right? Aside from that, people's retirement savings are getting impacted. They may be using those as reserve funds or something. And the other thing we're looking at, right, is the bond market. So something a little bit unusual that happened, normally when we see a stock market rout like we saw, the thing we see is the money moves from the risky thing, the stocks, to the safe things, which are bonds, 10-year treasury bonds, long-term bonds, what we're talking about here.
Right.
And usually what happens when that money moves, the price of those bonds goes up and the return on them, the yield goes down. Well, that yield is really what kind of determines the mortgage rate in a lot of sense. It started that way. The first week of the market going down, we saw that pattern where we saw mortgage rates start to drop. Everyone was getting pretty excited.
Mm-hmm.
We started seeing, rates move down close to 6.5%. We're like, stock market going down is not great, but for us, rates going up.
I certainly saw more buyers decide to be active in that 6.5% range for sure.
Right. And then we get to the following week, Tuesday evening, or I think it was Monday or Tuesday evening, we saw some stuff happen in the bond market. So the stock market was still going down. And then we saw bond prices also start to go down. I mean, those yields started going up. At their peak on a daily basis, they hit about 4.5%. Usually when we've been around there, we've been around 7% mortgage rates, right? So we saw a pretty substantial rise in the mortgage rate happen over those few days following that. Right now, we're sitting at about 6.9%. We've been flirting with 7% kind of ever since then.
Honestly, over time, right? 7% is not that bad. It's pretty close to the average. But if you've been looking in the last couple of years, or you bought during COVID and now all of a sudden you're looking at 7% because you need to move, you were looking at a way different property than you were just a couple of years ago. And that 6.5% to 7% shift changed the mindset in a lot of buyers that were making offers, because all of a sudden their very clean at list price offer turned into needing credits to buy down their rate or seller concessions to help with closing costs. And so there's a big shift in just the last couple of weeks. Yeah,
I mean, it's a meaningful change, right? Half a point matters. And yeah, 7% historically speaking is not too far off the average. But, we're coming out of that pandemic era where we saw, home prices in a lot of places. Yeah, we were at 2.5%, 3%, and we saw home prices go up by like 40% over a couple of years in a lot of places.
Yeah.
So that affordability measure, there's a lot of pressure on that right now. As we get into what's going on with the home sales a little bit, we'll really see the impact it's having. But affordability is at quite challenging levels right now, especially for first-time home buyers.
Yeah.
So I guess the next thing is kind of like, why did bonds go the other direction as opposed to what we normally expect? Is a couple of things, right? The short answer is tariffs. the concern here is this situation that we're getting into right now, which is, potentially they'd have upward pressure on prices. And it was the knee-jerk reaction, right? We've seen that policy change. Initially we saw the initial schedule of tariffs that came out on April 3rd. Since then, most of those have been dialed back to 10%. We're at 145% with China right now. And as of this week, when we're filming this, we're hearing, talk that could be reduced. It's actually got the stock market, we're on a couple of days now of a positive run, making up some ground back toward that peak. And it's been driven by this sort of expectation that we may see tariffs reduced. So the other question is well, why do tariffs cause this? Well, a lot of it has to do with kind of concern about the U.S. economy, concern about what's going on with U.S. financial markets. We're basically seeing, in a sense, like some version of capital flight, right? People are moving money out of U.S. treasuries, out of the U.S. stock market, out of the dollar even, because we've seen the dollar coming down, and moving it to other places. So we've seen them move money into Europe, into the euro, into other stock markets to some extent. A lot of it's still in bonds, right? It's still moving safe places for the most part, but it's safe places that aren't denominated in U.S. dollars. In the short term, that's, what we're kind of seeing is, I would call it like a flashing yellow light. It's a warning. Typically the places we've seen this kind of activity in the past, and usually on a bigger scale than what we're seeing in the U.S. right now in terms of percentages, are countries where essentially investors have lost a substantial amount of confidence in kind of the stability of that market. So either there's some government policy or some economic shock, or some other cause that's saying, we don't view that as safe. We think there's too much volatility in that place. We're going to move our money out. It's usually been more developing countries. We saw it during the Latin American debt crisis, the Asian debt crisis. We saw it during the 2008 financial crisis with some of the countries in Southern Europe. So that's where we normally see this pattern. We've normally not seen this in a place like the United States, where we more or less operate as the financial center of the world. So it's a little concerning. Right now, I would say, we're on yellow flags, not red flags. But it is something that, tends to function as a warning sign for a financial crisis.
We've said for years that you need to be the economist of choice in your local market, as for your consumers, for yourself, just to have knowledge. And I feel like this is one of those times where that's actually the most important, to be able to, one, understand for yourself, to be able to explain to your clients what's happening, right? I think there's a lot of people that are scared right now. Agents are scared, consumers are scared because they just don't know what's going to happen because things are changing so fast. And I think being able to watch something like this or keep up with the local news, not on TikTok, is super important right now to be able to serve your clients at the best ability that you can.
So NAR release this morning, actually, as we're filming this. And the results were a little bit interesting, right? Home sales were down, I think 6% from almost 6%, 5.9% from February. We're down 2.4% year over year. When we were looking at that. And home prices are still up, right? Which is a little bit, surprising given how much things are slowing down, but we're still up 2.7%. So down from last month. Last month we were at rising 3.8%, down to 2.7% appreciation this month. So it's slowing down. And, part of what's driving that is inventory. We're up to 1.3 million listings according to NAR, which, that's not a huge number when you look back, but given how much sales have kind of contracted, it's meaningful. We're up about 20% from where we were last year. And we're seeing significant. Yeah, that is significant. We're seeing bigger numbers than that in certain markets. I was looking across the country and we're seeing, places in the South and the West where you're seeing 30+% increases in active listings year over year. And the different story in the Northeast, we're seeing places there where it's actually gone backwards like 5%. If you're in New York, Pennsylvania, those markets are still very tight. It's alleviating a little bit in, I think, New England. I think when you look at places further north, I was looking at New Hampshire and Vermont, and they're seeing a little bit, 20%-ish, I think, increases, but from very low levels, right? So those markets are still seeing a lot of rapid appreciation. Based on NAR's number in the Northeast, we saw 7.7% home price appreciation in the median, right, this last month, year over year. That's a lot versus the South that was 0.6%. So that's all about like this push and pull between supply and demand that's happening right now. We're seeing a lot more listings coming on the market in the South. The West is a little bit in the same field, but not quite. And then the Midwest is a little bit better off. They're at, the Midwest prices came up about 3.5%. In the West, they were at 2.6%. So they're kind of, the middle right now, and on the ends are you have the Northeast at the high appreciation rate and the South at the lowest appreciation rate, where you probably have markets in the South right now that are going backwards in terms of home prices.
You can't really generalize it across the country. Being here in Texas, I can say that, in Austin, we have a lot more inventory coming on the market every day. And if sellers are pricing right, those homes are going fast. And if they're not, they're sitting on the market for 60 plus days. And same thing with buyers, right? If you're informed about what's going on, you're looking at those homes that are sitting on the market a little bit longer, or things that are coming up in your price range and moving quickly because you can.
Yeah. I mean, I think, talking to the agents I've chatted with recently, like they're starting to feel maybe, I wouldn't say for the first time, depending on where you were, this started last year, but it's a meaningful shift in the market.
Absolutely.
From, a seller's market that we'd been in for many years, and we kind of hit a slightly more balanced area. And now we're really starting to see more places in the country that are probably seeing like true buyers markets, where the leverage truly lies in the hands of the buyers, where the listings are easier to come by than the buyers are.
Yeah.
On the business side of this, it's a shift, right? Like that's not where we've been. If you didn't get in the market until after 2013 or 2014, as an agent or a homeowner, you've not lived in this before, right?
Yeah.
We're not where we were in 2009 in terms of inventory yet, but it's probably more like that right now in a lot of places than it is like what it was here in 2021 when you could barely get the sign into the ground in front of the house before it was sold, right?
Yeah.
So I think a lot of people's mentalities are going to have to adjust.
Yeah. I think it's, unfortunately, it's for sellers, it's a hard pill to swallow because they're looking up, not really understanding why they can't get what they want for their house because their neighbor sold for X amount more 2 years ago and that they can't sell it in the first weekend. It's because they haven't sold in a couple of years. That's a hard pill to swallow. And for buyers looking up, the houses are cheaper, the interest rates are higher, but there's more opportunity for homes. There's more listings. There's more opportunity to get houses under what they could have sold for a couple of years ago. So it checks and balances a little bit, but it's a hard pill to swallow, I think, for most even agents right now because it's harder to find listings, shockingly, because, they're up, but it's harder to find listings. It's harder to get buyers to actually bite the bullet and put an offer in on a house. And so it's a market we haven't experienced in several years. It's just not as easy anymore.
Yeah, right. Like affordability is still not good. Buyers may have more leverage, but the buyers that are in the market are going to want a better deal for their money, right? Because they realize like I have a little bit more leverage right now because there's not a lot of us out there on the buyer side. And I'm also seeing how much more I'm paying than maybe what my current mortgage rate is, right?
Yeah.
So, like I want that value. So it's definitely going to be a tougher conversation. I remember, talking to agents when I first got into this business back in 2012 and hearing about, how tough it was to be a buyer's agent because you'd show somebody 60, 70 houses potentially.
Hey, been there.
Right? Because there was so much inventory on the market. Like, I don't think we're there yet, but that's the difference, right? Like we haven't been in a place like that where, people were driving buyers around every day of the week and not making offers, right? Like we're kind of coming back to a world potentially that's a little bit more like that.
Even here, there's houses that are going in the first weekend. There's neighbor houses that are sitting on the market longer. There's buyers that are still out there competing for the homes that are priced right because those sellers understand what's happening in the market and where they need to be in order to sell fast. And so I think for a consumer, it's understanding what's happening in the market to be able to price your home right, to get it sold in the time frame that you want it sold in. And for agents, it's understanding what's happening in the market so you can inform your sellers and your buyers what's happening and help them be more educated to be able to make the right decisions for them.
All right, so mortgage rates.
The best.
Yeah, we've kind of hinted at it a little bit. We talked about it a little bit with what was happening with the markets. So we know they've moved up, right? We saw, April's been a little bit of a roller coaster ride, right? They were high most of the beginning of the year. We saw a dip. We saw rates start to move down to 6.5%. We got a little excited. Then all of a sudden they jumped right back up. So we're sitting at, close to 6.9% right now. And, it's looking like it's probably going to hang around there for a little while. I don't see a lot of, evidence that, on the horizon, we're going to see any meaningful decline in rates. It's possible we're going to see a lot more volatility. We could keep seeing rates bump up and down, but I think we're going to be in the mid to high sixes, probably for at least the next several months. Even a lot of the forecasters at other places like Fannie Mae and Freddie Mac have seemed to also be adjusting their, second half of the year projections for mortgage rates up a little bit right now. So that's not to say that they're going to be higher than they were last year, but it is to say that they're going to be higher than we thought they were going to be when we came in at the beginning of the year. So what does that mean, right? So in terms of home sales, that means a lot of projections for, total existing home sales this year are starting to get adjusted down a little bit. So far, they're still in the range of 4.2 to 4.3 million for the year. If I was a betting man right now, I'd probably take the under on that, where things stand right now, looking at where mortgage rates seem to be going. And that'll be kind of the driving factor, right? If we go into the summertime with mortgage rates down from where they were last year in a meaningful way, a quarter of a point at least probably, I think we've got a good chance of getting to those projections, seeing some strong sales this summer, at least stronger than they were last year when they were pretty low. Last year for most of the summer months,
it's tough.
Yeah, by NAR's numbers, we were hitting below 4 million seasonally adjusted home sales, right? That's slow. So with some luck this summer, we could hopefully be above that, but I think mortgage rates is going to be the driving factor. So unfortunately, in the end, it's going to require a better understanding of what's happening with policy and that to really hit a stable place, I think, for us to get there. So we'll see, how things evolve. The most recent news is positive. So hopefully by the time this video comes out, that's still the case. So we'll see. The Fed isn't going to be the thing that fixes this for us right now. The challenge with tariffs is it puts them in a tough spot. When Jerome Powell spoke most recently, he talked about the potential that there are two mandates. We've talked about that a little bit before, which is, one mandate is maintaining, stable prices. So basically inflation, keeping that in check with their 2% goal. And the other mandate is unemployment. So keeping the economy as close to full employment as possible. He basically said he sees a scenario right now where those two goals are at tension with one each other, meaning in order to help maintain one where I need it to be, I might be hurting the other one. I might be making it worse, right? So that means that what the Fed's probably going to do in the near future is basically sit on its hands until they see a problem. And when they do see a problem, they're more likely to favor inflation over unemployment. Like another thing that he said to kind of get that point across was essentially, and I'm paraphrasing here, that stable prices are necessary both to maintain inflation at goal and to have full employment. Basically meaning that that's the foundation. The first step is making sure prices stay stable, and then we can deal with unemployment. So what that said to me, listening to it, was essentially when we get in a place where we potentially see, maybe we see some slowdown in the economy and we see unemployment start to come up some. If prices are also going up, the Fed's not going to bail us out by lowering rates.
Yeah.
So that's sort of another thing that put some fear into the markets. That was like a sort of compounding factor with what was going on in the stock market as well, was this idea that even in this bad scenario, we're not going to get lower interest rates because the Fed's not going to just drop rates due to the fact that we may see prices coming up. So, right now where we're at is still, that's all forward-looking stuff. The current economic statistics, inflation was actually at a very good level. It came down some this last month when they measured CPI. Unemployment's still very low at 4.2%. So we're sitting on stable, steady ground right now. It's just looking increasingly shaky as we go forward. So, we're kind of looking out, asking the question of where are we going to go? And it's the horizon's starting to look a little bit cloudier than it did 3 or 4 months ago. But in the end, we're not there yet. So a lot can change. We have to monitor the situation, really kind of see, where things settle at as we get, a month or two down the road.
It's tough, right? Because I think that all of that, everything goes into buyers, especially being more scared to do anything. They're scared they're going to lose their jobs and can't afford a house. They're scared that in a month when they find the perfect one, that interest rates are going to be way higher than they expected them to be. And so one of the lessons I took out of that was if you've got an interest rate right now that you're comfortable with, lock in, find the perfect house, right? And watch the news. Yeah,
I mean, I think that's it. I think to recap, where we're at right now, we've got this stock market situation that's creating a lot of instability in markets. It's put upward pressure in the end on mortgage rates. We saw home sales come down. I will say, as we think through that, that's March home sales. This all happened in April, right? We saw, the stock market was already going down in March for other reasons, but we saw the big drop happen after the tariffs got announced. So that's away from this. So we're already seeing some of the effects of, uncertainty in March sales. We'll probably see it again in April sales as we go forward. So we kind of have to keep an eye on that. In the end, mortgage rates are probably going to stay elevated for quite some time. The Fed's not going to fix that for us. So we should expect to continue to see kind of slowish home sales, building inventory on the market, which is like, we talked about the opportunities there, like it's good and bad. We're going to see more options for buyers than we've seen in quite a while, right?
Yep.
You just have to, if you're a seller though, you have to go find the buyers. Like that,
Yeah.
that's where the challenge is going to be, I think, over the next few months. Is going to be finding the buy side of those transactions.
Yeah. And pricing right, knowing what's going on, listing at the right time for you. There's not always a right time in the year, right? And just understanding that it might take a little bit longer.
Yeah, you definitely don't want to be chasing your home price down right now, right? Like it's not the market for that. Having good conversations between, agents and clients on where prices are right now and where they're going is going to be very important. Because we know that we've seen situations where, you don't want to be the house in your neighborhood that's, leading off the
Yeah.
price drops, right?
Any advice I could give an agent right now is to take all of this information, put it in a weekly newsletter, not monthly, weekly, because we know that everything changes month by month so quickly, and get that information out to your buyers and sellers.
Yeah, absolutely. Well, Joy, thank you for joining us this month on our market update and sharing your insights.
Thanks for having me. It was a blast.
And thank you guys for joining us as well. If you like what you hear, please like and subscribe on YouTube or wherever you get your podcasts.
Tune in next time.